This is the view most retail traders start with: a frantic, high-speed, one-minute chart, buried under shifting histograms and flashing execution arrows. This specific environment is why the first 2 years of a retail trader's career are generally a financial bloodbath. Most beginners focus entirely on these instantaneous triggers, searching for a machine-generated buy or sell signal before they even understand where they are on the market map. Trading off a one-minute chart without macro awareness is like a medical student skipping anatomy and biology, asking for a scalpel to perform open-heart surgery. To learn how to strike, you must first learn how to see. We are stripping away the noise, hiding the execution arrows, and muting the fast histograms. Professional market operators define the macro regime first, relying on 2 distinct structural pillars. Those pillars are multi-timeframe mean gravity and quant level boundaries. Profitable market execution requires first defining the structural architecture in which the price is operating. Building an institutional trade grid starts with a completely empty macro-level landscape. We begin with the multi-timeframe mean, a singular, heavy baseline that acts as a core anchor for price data. These moving averages are not random support lines where the price is supposed to bounce based on a retail pattern. They are dynamic measurements of speed, mass, and institutional value. In this system, the mean represents gravity. An object can launch into the air, but the further it travels away from the baseline, the more kinetic energy it loses until gravity pulls it back. The market operates under these same physical laws. This creates a specific market state: escape velocity. When institutional block orders drive price vertically above the mean, the asset detaches from gravity and enters a runaway trend. In this state, the rules are absolute. You never try to pick the top of an asset in escape velocity, and you never short it just because an oscillator says it is overbought. But every trend has a limit. Like a rubber band, the structure can only stretch so far before the tension becomes unsustainable. When the vertical distance becomes too wide, smart money stops buying the highs and begins distributing their inventory to late-coming retail chasers. Once the price structure breaks, gravity takes over. The asset pulls back violently to the mean to rebalance the price against the institutional value anchor. Respecting this gravity ensures you are never the sucker buying at the absolute peak of a stretched rubber band. With gravity established, we introduce the second pillar of macro orientation: quant levels and standard deviation boundaries. While amateurs draw subjective trend lines based on how they feel, institutions operate on quantitative algorithmic coordinates. These quant levels are fixed, pre-calculated coordinates representing the permanent geographical landscape of the market. If the multi-timeframe mean tells you which way the river flows, these levels tell you exactly where the concrete walls and waterfalls are located. These coordinates operate through the law of attraction and repulsion. Inner levels act as institutional magnets. When a trend launches away from the mean, it seeks a mathematical destination, moving efficiently from one quant level to the next. But at the outer standard deviation boundaries, the level switches from a magnet to an iron wall. These outer bounds represent where momentum hits a limit. This is where institutional resting limit blocks are waiting to absorb the remaining orders. These coordinates mark maximum tension points, the high probability zones for an institutional ambush. Layering these levels over the mean transforms price chaos into a predictable combat grid. The final exam of this foundation is the mixed blunder state, the environment that separates professionals from amateurs. This occurs when the multi-timeframe means desynchronize. The fast timeframes point down, while the macro timeframes slope up, causing the lines to twist into a knotted braid. In this state, the market has entered a structural inventory rebalancing cycle. Price becomes compressed in a cage, bounded tightly between 2 primary quant levels. This is where human psychology destroys the retail account. A fast green candle looks like a breakout, enticing amateurs to buy the top right into a quant ceiling. It reverses, hitting their stop loss. They flip short at the absolute bottom into a quant floor and get squeezed out. They are attempting to trade momentum in an environment that currently lacks directional speed. Recognizing this cycle is the only way to avoid providing the liquidity that algorithms need to rebalance. Graduation from this foundational phase requires mastering the discipline of cash. Staying flat in a mixed, desynchronized market is a deliberate, high-level trading skill. A professional operator steps aside, keeps their capital protected, and watches the retail crowd chop themselves to pieces in the knot. If you cannot instantly identify the state of gravity via the mean, you have no business clicking a button. Entering a combat zone without mapping your permanent quant boundaries is financial suicide. Stop looking for fast execution arrows on low time frame charts. Protect the machine and wait for the macro gears to cleanly align. True edge comes from understanding the structural boundaries deeply enough to know exactly when to wait.